So let's see an example of the three-statement evolution if we start a cafe business. I've seen many lectures teaching accounting, even textbooks in universities, in private institutions. They all have very similar approaches when we start talking about the accounting basics, and I'm doing that as well. So it's probably going to be the same if you hear this lecture from other institutions as well. Only this part changes. Some people use cafes, some people use restaurants, lemonade stands, and so on. So let's say that we've started with a 1 million loan from a bank to start a cafe. So we borrowed 1 million and we used up 1 million from my own equity. So I'm investing my own money, $1 million, and I'm lending $1 million from the bank. As soon as you lend money, that's not a part of your performance. You're just simply lending money. You're just simply borrowing money. So it's not part of your performance. So the income statement, nothing is yet recorded. But at the balance sheet, now we have cash worth 2 million, which was funded by 1 million liabilities and 1 million equity. For your reference, we're going to deal with this details a little bit later, but for your reference, usually the right-hand side of the balance sheet describes how you have financed your fundings. So it shows you funded 1 million from liability from the bank, and it shows that 1 million was funded from your own equity. And the left-hand side shows assets. So it shows what you've done with your fundings. So now you can see that we have cash worth 2 million in your assets side. And of course, for the cash flow statement, we're going to deal with it later. But if we had a cash flow statement, it would show a surplus of 2 million in cash, because simply your business now has $2 million more worth of cash. So a cash flow statement is very simple. Next, let's say that we've purchased a barista machine. So this machine is used to produce coffee, and we used only $0.5 million in cash instead of using the whole 2 million. So let's say we use this. Still, nothing's going to be recorded on the income statement because, well, we've never sold any coffee yet. So this transaction alone wouldn't record anything on the income statement, but rather on the balance sheet, now we have 0.5 million less cash, which has been substituted to property, plant, and equipment. So this, by definition, means assets that are going to be used to produce revenue. So this has been substituted to property, plant, and equipment, but still the asset side still has 2 million in total. The liabilities and equity sides haven't changed, so still 2 million in total. So that's what changed. And finally, on your right, now we've finally sold some coffee. We started doing our operations, and 0.5 million was recorded as revenue, while we also had to spend 0.2 million for labor costs. So finally, the income statement shows some changes. So income statement now, revenue is recorded 0.5 million. Expenses and net income. So now we have income worth of 0.3 million. This is where it gets a little bit tricky. Of course, this is just an introduction, so you don't have to necessarily understand everything. But anyways, the balance sheet now, finally, so now we have 0.3 million more worth of cash, because now we've earned 0.3 million in cash. Whose money is this? This is your money. This is the CEO. This is the founder's money. Because That's what you have earned. So that flows into your portion of the liabilities and equity side. So it doesn't affect the bank's portion of your funding, but rather it's being accumulated into your equity. So 0.3 has been increased on the left-hand side and as well, and on the right-hand side as well. So still, now the total is 2.3 million in the asset side, 2.3 million with liabilities and equities combined. So 2.3, 2.3. We've seen gross was 0.3 million because the company's total asset size was 2 million when we first founded this company, but because the company did a good job in operating, now the company size has grown. But next, let's say you have decided to pay off the loan because now you've earned money, so you want to repay the bank of your liabilities. So what's going to happen? Paying off debt. So it's not, again, it's not related to your performance, your business performance. So it's not recorded on the income statement, but rather what happens is you've used up 0.3 million cash to pay off loans. So 0.3 million would decrease, the cash balance would decrease. But on the other hand, now for the liability side, the balance would decrease by 0.3 million, and now we have 0.7 million. The total asset size, so before your operating activities, the total size is the same, 2 million. But look at your portion. Your portion has increased. So you've only had 1 million in equity, but now you have 1.3 million in equity. So that's what matters. Despite the fact that the total asset size, the total enterprise value is the same, but your portion of equity value has increased by 30%. So this is a typical income statement and balance sheet evolution. One thing to notice is that the income statement only records something when it's related to your performance of your operations. So performance of your core business. So this was just to give you a simple idea of how the income statement and the balance sheet works. We're going to look at it, much more detailed and much more deeper. And we're also going to see the cash flow statement as well and the relationships between all three statements. But for now, I hope this gave you an idea of how the income statement and the balance sheet works.